Commodities have enjoyed a strong rally throughout 2021, surging to multi-year highs, with some commodities like natural gas and aluminium seeing their prices more than double in the last 12 months. The overall market has seen a huge volatility spike over the past year, and some experts are referring to this as a commodity supercycle, where we're seeing prolonged period of high prices in the market. Joining me today is Nitesh Shah, Head of Commodities and Macroeconomic Research at WisdomTree, to give us his views on the performance of commodities and what to expect in the next few months. Nitesh, welcome. And first of all, can you give us your views on what we've been seeing in the commodity space recently? And is this really a commodity super cycle?
Well, Daniela, firstly, thank you for having me on your show. And yes, you're right. Commodities have had a spectacular time over the past year. And it's quite surprising given that we've been in this pandemic stricken recession. But the recovery has been very strong and very powerful for the commodity space. As we've entered this recovery, we've seen the demand for all cyclical assets, so energy, industrial metals, for example, increase tremendously. So the demand rebound has been very strong for these kinds of commodities, propelling their prices, while supply has been quite constrained. But at the same time, it's not just this kind of cyclical rebound phenomenon that's driving commodities. We think there's something more structural than this. And once again, coming out of this COVID pandemic, well, I'm not sure we're quite out of it yet, but as we're starting to see the conditions really improve, what we've seen is there's been a lot of fiscal firepower being directed at things like infrastructure. So you've seen in the US more than $1.2 trillion worth of spending being approved by Congress into infrastructure. That will likely propel commodity markets for the next decade or so, given that infrastructure is very commodity intensive. But added to that, there is a dimension of a energy transition undergoing. And now that what we mean by the energy transition is that there's a desire to use more renewable sources of energy and less hydrocarbons. Now that will change the types of commodities that are used for our energy consumption, more towards metals and possibly less from traditional hydrocarbons like coal and oil. And that will change the types of commodities being consumed. For what that means is that the price of metals are rising quite substantially as the supply for those metals hasn't yet caught up. In the short term, energy space is still seeing quite a vigorous rebound while supply is quite constrained, partly because of OPEC, the oil cartel hasn't really increased production enough to hit demand. So we're kind of firing on all cylinders, really. All aspects of the commodity market are really rising simultaneously. And we expect some parts of that to continue on for this next decade. And it's primarily industrial metals that will probably see this phenomenon of a super cycle. So it may not be broad based against all commodities, but definitely in the industrial metal space.
Yeah, you were talking there about industrial metals and how they've seen this strong surge in the year, and obviously the infrastructure spending and this move in the energy space. I think it's curious when people traditionally think about hedging or trading with commodities, they instantly move towards precious metals or energy in the case of oil. I think as we're trying to move away from this situation into a more normal situation, you could say, we don't really know what's going to happen right now, but potentially in 2022, if we move to a more normal situation, do you think that we're still going to see this surge in industrial metals because of what you said of infrastructure and spending? Or do you think that people will then revert to the traditional kind of precious metal and oil trading, and we'll see a move away from these newer sources of investment that we've seen?
Yeah, that's a great question. So, I think, if I were to sort of plot out what's going to happen over the next few months, well, we actually are seeing a bit of a slowdown in China, for example, and even with some of the big sort of like industrial indicators like purchasing managers indices or composite lead indicators, they look like they've gone past their peak. Even though they're still in expansion territory, they've gone maybe past the peak growth levels in those indicators. So I could see a bit of a pullback in some of the industrial metals as the cyclical story starts to slow down. But as you point out, it's the energy transition that is a secular trend, and that's going to propel industrial metals, I think, for the coming years. Is mainly because So while the demand for these industrial metals is likely to rise rapidly, with more demand for transmission, electrical transmission cables, distribution cables, the metals needed in batteries, for example, the supply of these metals hasn't really been rising. There's been very little capital expenditure in the mining industry, and even when there has been capital expenditure, it has to work against the grain of declining quality of ores or in existing mines. So you have to almost dig deeper, and you have to spend more money to pull rock out the ground to be able to get the same quantity of metals produced. So we think, while the supply situation is quite constrained and demand is rising, industrial metals are likely still to continue to do well in 2022. Precious metals, I guess, on the other hand, they just have to deal with one difficulty of rising interest rate environment that we're likely to face in 2022. The Federal Reserve has pretty much indicated its tapering path. That will mean that long-term treasury yields are likely to increase, but once they get hit into this sort of rate rising trajectory, even on the short end, that will also curtail bond yields, and that tends to be negative for gold prices. So, I think that the industrial metal will still trump precious metals going into 2022.
Staying with precious metals, I just want to get your views quickly on gold, as we were just mentioning, and obviously interest rates going higher. But I think the great topic right now we've seen for the last 6 months or so is inflation and what's going to happen with inflation. Is it transitory? Is it not? And I think with this situation that we're seeing now, there's been a lot of talk about whether gold specifically is a good inflation hedge. Now, if you see research, especially about past inflationary times, the research suggests that you haven't always gotten a great return from gold as an inflation hedge. What are your views on that? And especially with the way inflation is going into 2022 and seeing that producer prices are still rising, and that could eventually lead down further into consumer prices into the new year as well. What's your views on, is it a good inflation hedge, and what would you do regarding this views on inflation heading into the new year?
Yeah, so actually, our research has indicated that gold historically has been possibly one of the best hedges for inflation, especially when inflation's extremely elevated, like we saw in the 1970s. And gold is a very strange asset in that regard. It's, very often people think of gold as a defensive asset, something to hold at a time when economic conditions are deteriorating, in the same way they hold bonds. But gold has this strange kind of distribution of performance. It does well in the bad times, bad economic times. It does well in the good economic times as well, mainly because those good economic times are associated with elevated inflation, because there's lots of demand for goods and services at a time when the supply is quite limited. Now, that's history. Now, unfortunately, in this cycle, gold hasn't quite lived up to its reputation. We've seen inflation heading to 30-year highs in the US, and yet gold prices haven't quite been where I'd expect them to be. According to the models that I've produced, gold should be trading way in excess of $2,000 per ounce, with inflation at 6.2% in the US. And at the moment, we're at what 1795. So there's quite a large gap there. And if I look at the sort of attribution of my model, seeing what should be driving gold prices and what is moving gold prices, well, most aspects seem to be moving gold in the right direction, apart from the inflation component. So in this cycle, it's doing something strange. Now, if I were to look at inflation and say, well, we got actual inflation, the inflation that we see, the prints that we get from the statistical organizations, versus the inflation expectations. And there's various ways of looking at inflation expectations. One way is just looking at the difference between a nominal yield on a bond and a inflation protected instrument. So looking at kind of a break even. It seems like gold is really tracking that inflation expectations more than actual inflation. Now, that's an unfortunate situation because, gold and commodities in general generally be very good at tracking the realized inflation, not just the expected inflation. But it seems like gold is getting sort of left out in this cycle a little bit, and is behaving a lot more like sort of equities or bonds in that regard, where it's just looking at expected inflation. So this cycle has been a little bit of a disappointment. We started to see when we got the very last inflation print for the month of October, we did see inflation, gold start to react quite strongly there. But that was sort of battened down when we started to see slightly more hawkish talk from the Federal Reserve, indicating that rates will be rising on a slightly faster path. So what I do see is that gold has possibly got a window of time to make some catch up to the reality of the inflation situation before those treasury yields start to really rise and the dollar starts to appreciate before we start to see renewed headwinds for gold.
Great. And just very quickly, there's been a lot of talk, obviously, about, why gold hasn't been living up to expectations. And a lot of people are coming up with the fact that people are looking at other alternative investments and potentially Bitcoin being one of the outperformers, especially in the latter part of this year, taking maybe that shine away from gold. Do you have any opinions on this?
Yeah, so it's very interesting because gold and Bitcoin, or other sort of cryptocurrencies have quite a lot of theoretical similarities, right? They are limited in supply, which is the primary thing. So, gold, you can only increase its supply at the rate you can mine it out of the ground. And in terms of Bitcoin, it's that kind of electronic mining of the Bitcoin that determines its supply. And we know by just its formulaic construct, you can't increase it at a very high rate. And they both are seen as pseudo currencies, right? Alternatives to fiat currencies such as the dollar or the yen or the euro. But the contrast is because you can't increase the supply of Bitcoin or gold at the same rate you can increase dollar, yen, and euro. These hard currencies should possibly hold its value for longer. So that's why lots of people compare the two from a theoretical standpoint. But in practice, I feel like their behavior is being very different. Gold, as I mentioned earlier, has a lot of defensive traits about it, whereas from the relatively short life of these cryptocurrencies and Bitcoin in particular, they operate in a much more cyclical fashion. So they behave quite differently in practice, but it doesn't mean that people don't buy into the theory of the similarities between Bitcoin. And I feel like, yes, there is possibly some room there that would-be gold buyer has been buying Bitcoin instead of gold, moving progressively into the more digital era. So yeah, at the margin, I think they possibly have been competing with each other, especially as gold demand has been a little bit stagnant in the past year relative to what we would have expected, whereas demand for Bitcoin has gone from strength to strength.
Now, bringing it back to the energy space, carbon has been the latest commodity to see a rapid surge in prices. What would you attribute this move, and do you think that COP26 has had an effect on the price of carbon, given what we saw at the conference?
Carbon has been rising massively. I mean, so if you look at the European Union allowance or price, that has risen from roughly 33 euros per ton at the end of last year to close to 76 euros per ton this morning. So it's more than doubled. And the key things that are driving this is a renewed vows to keep the climate goals that many countries have signed up to alive. So, putting this into context, you've got the Paris Agreement, which is to limit global temperature increases to just 2 degrees above pre-industrialized levels, and ideally to 1.5 degrees. But last year, the European Union implemented into law a net zero pledge by the year 2050, and to limit greenhouse gas emissions to 55% by the year 2030 relative to 1990. So, with that now in law, the European Union has to figure out how it's going to adjust its policies to be able to be consistent with that law. And in July of this year, they announced a legislative package called the Fit for 55 legislative package. It's under consultation right now, but they want to be able to, get in line with that. So in the absence of this legislation, they would only be able to reduce greenhouse gas emissions by 40%, not 55%. So, with the policy direction likely to become a lot more aggressive, the price of allowances under the EU's emissions trading system has increased substantially. But also, it's happening in the backdrop of this economic rebound that we've been in. So, all the economic activity over the past year has increased, and therefore the demand for the allowances, given that economic activity usually translates into more polluting activity, so the demand for the allowances has increased. Now, in recent weeks, we've seen quite a big surge in carbon prices, and it's all to do partly with the compliance period. So the compliance period for the emissions trading system in Europe is a calendar year. So as we approach the end of the year, lots more companies have a better idea of how much emissions they put into the atmosphere, and are therefore trying to acquire the allowances to cover that. So many companies are acquiring the allowances either on the spot market, or are taking delivery or getting ready to take delivery of futures and putting in their hedges for the forthcoming year, as the December futures contract is about to come to expiry. So there's a number of things that are driving things there. In COP26, the recent UN conference on climate change, you could see a broad-based reconfirmation of trying to get to those Paris goals. And I think the vote of confidence for this has really helped for these regulated markets. Now, remember, carbon has multiple markets. It's not just one market. So you've got the regulated European emissions trading system, which it's largely been talking about, but you've also got the voluntary carbon markets, where companies can voluntarily participate in buying of carbon credits. And in COP26, there was actually quite a lot of movement in terms of improving that market, laying down the foundations for improving its credibility and its integrity. So multiple aspects of the carbon market have been doing quite well in this environment.
And just to finish off, what would you say, if you have any, is the undervalued trade in the commodity space going into 2022?
Yeah, so I guess kind of alluded to this earlier. Gold is undervalued. My models, tend to point to gold being above $2,000 per ounce, whereas as I mentioned, we're at sort of 1795 right now. So that's a clear underpriced commodity. But closely linked to that is silver. Silver and gold have a very strong correlation, roughly 80% correlation between the two. And silver's been dragged down, so that's also equally undervalued. Also in the precious metal space, you've got palladium. Now, palladium doesn't have a stronger correlation with gold, but palladium has possibly been held down this year because the main use for palladium is in cars, in the auto catalyst. It's used as a catalytic material to turn nasty gases into safer gases. This year, because of the chip shortage, there's been less manufacturing of cars than would have been the case. Now, as we head into 2022, I expect the chip shortage to alleviate a little bit and car sales to increase. So I think the demand for palladium will likely rise. From a supply standpoint, palladium supply is very tight. So there's definitely some room for that. And elsewhere, although you point out, and aluminium had hit all-time highs this year, and doubled in price, and there's been a pullback in the last month or so, but I think that's got some more legs to rise during the course of next year. Some of the pullback in aluminium was just linked to the fact that one of the biggest manufacturers of aluminium, China, had relaxed some of the constraints on using coal for a little time while energy was very tight. But I expect China to start to implement its restrictions on coal usage once again next year, which will have a knock-on impact on aluminium supply next year and be price positive. So a couple of the things that I think are a little underpriced right now and have strong legs to grow in 2022.
Well, thank you so much for all your wonderful insight. That was Nitesh Shah, Head of Commodities and Macroeconomic Research at WisdomTree, giving us his views on the performance of the commodity market. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.